I have a simple question for you, but the answer might cost you everything you own if you get it wrong. What is the price of an ounce of silver? If you look at your phone, if you look at CNBC, if you look at the COMEX ticker, it tells you the price is $100, and everyone is celebrating. They think $100 is the ceiling. They think $100 is expensive. But what if I told you that price is a lie? What if I told you that in Shanghai, in Tokyo, and in Dubai, the places where they actually build the electronics and solar panels that run the world, you cannot buy an ounce of silver for $100? In fact, you can't even buy it for $120. Right now, as you watch this video, physical silver is changing hands in Asia for $140, $150, even $165 an ounce. There are two prices for silver in the world today. There is the paper price that Wall Street uses to gamble, and there is the real-world price that industry pays to survive. The spread between these two numbers is now 45% to 60%. It is the largest divergence in financial history, and it signals one thing: the Western banking system has lost control of the precious metals market. If you are waiting for a dip on the COMEX to buy, you are waiting for a ghost. The real price has already left the station, and the arbitrage window that keeps the West solvent is slamming shut. Welcome back to the channel. Hit that subscribe button, click the bell icon, and buckle up. We don't have time for fluff today. We are diving straight into the great decoupling that is creating the biggest arbitrage opportunity of our lifetime. Let's look at the data that is setting the internet on fire. Yesterday, a thread went viral on X, formerly Twitter. It showed a map of global silver premiums. It got thousands of likes because it exposed what the mainstream media is ignoring. In New York, COMEX, the spot price is roughly $100, but look at the premiums in the East. Shanghai, trading at a $40 premium, $140 per ounce. Tokyo, reports of physical settlement at $145 per ounce. Dubai, dealers asking for $165 for immediate delivery. This isn't a deal or markup, this is a structural break. For 50 years, New York and London set the price. They traded paper contracts back and forth, and the rest of the world just accepted it. If COMEX said silver was $20, then silver was $20 in Shanghai. That era is over. The East is now draining the West. We are seeing massive fleets of cargo ships and armored transport planes moving physical bars from London vaults to vaults in China and India. Why? Because the Chinese know that $100 silver is a gift. They know the real value is $150, so they are buying every single ounce the West is foolish enough to sell at the fake paper price. This is why you're seeing out-of-stock signs on U.S. dealer websites. This is why your local coin shop is empty. The metal is flowing uphill to the highest bidder, and the highest bidder is no longer in New York. Now, the economics textbook tells you this shouldn't happen. The textbook says if silver is $100 in New York and $140 in Shanghai, traders will buy in New York and sell in Shanghai until the prices match. That is called arbitrage. So why isn't it happening? Why is the gap getting wider every day? Because you can't source the metal. To do the arbitrage trade, you need to actually get the 1,000-ounce bars from the COMEX. You have to stand for delivery. But the banks are making that impossible. They are delaying deliveries. They are forcing cash settlements. They are putting up logistical barriers. But paper market is a walled garden. Inside the garden, the price is $100, but you can't take the silver out of the garden. Outside the garden, in the real world, the price is $145. This is exactly what happens right before a currency collapse. In Venezuela, the official rate for bread might be 1 bolivar, but the shelves are empty. On the black market, the bread is 1,000 bolivars, and you can actually buy it. We are seeing the Venezuelanization of the silver market. The COMEX is the official rate. It's a fiction. Shanghai is the black market. It's the reality. And here is the scary part. Asia isn't selling back. Usually when the price spikes, people sell. But China isn't exporting silver. They have put up export controls. They are hoarding strategic metals for their solar and military industries. It's a roach motel.
Silver goes in, but it never comes out. This ties perfectly into what we discussed with Ed Dowd and the BlackRock thesis. Remember, BlackRock manages $14 trillion. They don't move money based on feelings. They move based on risk. Ed Dowd warned us about the trust bubble popping. This is the trust bubble popping. When a buyer in Shanghai pays $145 instead of buying a COMEX contract for $100, they're essentially saying, I do not trust the COMEX to deliver. They are paying a 45% trust premium just to have the metal in their hand today. This is a vote of no confidence in the Western financial system. The smart money knows that the paper market is leveraged 500 to 1. They know that if they hold a paper contract and the default happens, they get nothing. So they are paying any price to secure physical. This is why BlackRock and the other giants are quiet. They're not going on TV telling you to buy silver. They are quietly positioning themselves in the physical market or the miners. They are letting the retail investors fight over the scraps on the paper exchange, while they secure the supply at the source.
The hidden shift is a shift from counterparty promises to physical possession. And the price of possession is skyrocketing, while the price of promises is lagging. I want to share some intel from the dealer network. I've been reading the forums, the dealer newsletters, the industry chatter. It's panic mode. Major U.S. bullion dealers are reporting that they cannot buy back product. Usually when silver hits $100, people rush to sell their old coins to dealers, but nobody is selling. The public is holding. And the wholesalers, the refineries, they are telling dealers, we have no allocation for you. Everything is going to Asia. One dealer posted on Reddit yesterday, I see spot at $100, but my wholesale cost to replace inventory is $118. I can't sell to you at spot. I'd go bankrupt. This is why you are seeing high premiums on silver eagles and maples. It's not price gouging, it's price discovery. The dealer is charging you the real price, not the fake COMEX price. If you're waiting for premiums to come down, you don't understand the dynamic. Premiums are the market screaming that the spot price is wrong. Eventually, the spot price must snap up to meet the physical price. The tail cannot wag the dog forever. When that snap happens, it won't be a slow climb from $100 to $110. It will be an overnight gap up. You will go to sleep with silver at $100. You will wake up and it will be $140 because the COMEX will be forced to reprice to match Shanghai or face a total drain of every remaining ounce in the vault. So, what does this mean for you? It means you're in the danger zone. If you are holding paper silver, SLV, futures contracts, unallocated accounts, you are holding the asset that is valued at $100. You are holding the asset that is being targeted for arbitrage. The banks are desperate. They need your silver to ship to China to cover their shorts. They will try to shake you out. They will try to crash the paper price to $90 to scare you. Don't fall for it. Every time the paper price dips, the physical buying in Asia accelerates. They love the dips. The lower the COMEX manipulates the price, the faster the vaults empty. You need to be on the side of the arbitrage winners. The winners are the ones holding the physical metal, because when the repricing event happens, your physical stack reprices to the Shanghai level instantly. You gain that 45% spread overnight. But if you're in paper, you might get cash settled at the low price right before the explosion. They will write you a check for $100 and say, sorry, force majeure. Meanwhile, the real metal trades at $150. Don't let them steal your upside. This is the most critical alert I have ever issued on this channel. The divergence cannot last. Markets hate inefficiency. $100 versus $145 is unsustainable. Either Shanghai crashes, unlikely given the demand, or New York explodes. We're betting on the explosion. The window to buy physical silver at anything close to $120 is closing. Once the mainstream media picks up on this Asia premium story, the FOMO will begin. And when the masses try to rush through the door, they will find it locked, out of stock. Don't wait for the CNN headline. Look at the map. Look at the spread. The truth is out there, but you have to act on it. If this video helped you understand the two-price market, smash that like button. Share this with anyone who thinks silver is too expensive at $100. Show them what it costs in Tokyo. Subscribe to the channel. We are tracking the Shanghai premium every single morning. Comment below, what is the lowest price you can find physical silver for in your area today? $115? $125? Let's build a global price map in the comments. Stay sharp, stay stacked, and I'll see you in the next one.